Welcome to our video explainer on preparing for Brexit. The UK is now just days away from the end of the Brexit transition period on the 31st of December 2020. After this date, the UK will no longer be part of the arrangements that have made trade and travel to the continent so easy. At the time of this presentation, the UK is still yet to sign a new trade deal with the EU, and there remains a significant degree of uncertainty, which is making it harder for businesses to plan for the future. This is made all the harder by the events of the pandemic, which continue to affect our everyday lives and the ability of many businesses to trade. It's still clear that many businesses still aren't fully prepared for what lies ahead. But there are certain steps that all owners can take now to build resilience and ensure their business is ready. So during this presentation, we hope to go over these steps and look at some of the implications that Brexit may have on your business, your staff, your suppliers, and your customers. We hope to cover a lot of ground during this presentation, but our team are also standing by to answer any questions you may have in the week and the months ahead. So what happens next? Well, businesses remain uncertain exactly how trade will continue once the transition period ends on the 31st of December. The UK government was said to be focusing on a Canada-style deal, but as negotiations become wrapped up in various issues, the Prime Minister Boris Johnson has also warned the UK to prepare for more of an Australian-style deal. Now, if you aren't an expert in international trade agreements, it may not be clear what the difference between the two deals mean in reality, especially when it comes to the introduction of costly new tariffs. So let's have a look at that. Well, Canada has a trade agreement with the EU and has done since 2017, known as the Comprehensive Economic and Trade Agreement, or CETA, which gives Canada almost completely tariff-free trade in goods. The deal also protects EU's geographical indications. Now, this is where a product with a specific geographical origin is protected, and items that fall under that are things like Camembert cheese or champagne. And this prohibits Canada from importing any goods using the same names from another country. Under CETA, Canada and the EU also cooperate on standards, ensuring that a product cleared under EU safety and security rules doesn't have to undergo further checks if imported into Canada. The main selling point of the deal are the increased quotes on exports, which allow a certain amount of product to be exported before tariffs are applied. However, it doesn't eliminate these charges altogether. So by way of an example, under CETA, the amount of tariff-free cheese that the EU can export to Canada increased from 18,500 tonnes to 31,972 tonnes every year. However, while 98% of products are tariff-free, import taxes do remain on some goods such as meat, eggs and poultry. Although these arrangements reduced regulatory trade barriers, Canada still faces more red tape and costs than EU countries do when trading with each other. So how does that compare to Australia? Well, despite all of the talk of an Australian-style deal, the reality is that the EU doesn't have a free trade agreement with Australia, although it is currently negotiating one. Should the UK trade with the EU using current Australian terms, businesses would not have the favourable access to the EU market they currently enjoy. Instead, they would face the EU's standard World Trade Organization, or WTO, tariffs when exporting to the continent, and EU businesses would face the UK standard WTO tariffs when exporting to the UK. This could mean that cars imported to the UK from the EU could be 10% more expensive, while the price of exported milk, cheese and some meat would increase by up to 30%. More importantly, the UK's key services market would lose any preferable access to EU markets under an Australia-style deal. In some ways, some commentators have pointed out, an Australian-style deal is very similar to a no-deal scenario. So the time to act is now, especially in relation to trade arrangements. So from the 1st of January 2021, the process for importing and exporting goods will change. Already there is speculation of long waits at borders and complications regarding the different types of licenses and customs declarations businesses need. Despite pledges to reduce red tape and bureaucracy as things currently stand, businesses that import and export will need to undertake new steps under the new arrangements. Businesses must begin to prepare for these steps now so that they can continue to trade with minimal disruption. And in its latest guidance, the government has laid out the principles for the core model, which relates to all goods imported and exported, regardless of which means of transport are used to move the goods. And the guidance covers the core processes of customs declarations, customs duty, import VAT, and safety and security declarations. Under each of these headings, it sets out the actions that businesses should take now, as they will be required to follow these rules regardless of the outcome of the ongoing trade negotiations. To help businesses adapt, HMRC will introduce the new border controls in the core model in 3 stages up to the 1st of July 2021. And to help prepare for these changes, businesses should apply for their EORI number, prepare to pay or account for VAT on imported goods, consider commercial arrangements and terms of trade, determine the customs value of goods, and considering how customs declarations to HMRC systems will be made and the use of a customs intermediary. Certain businesses may also need to check what export licenses or certificates they require, the marking, labelling and marketing standards for food, plant, seeds and manufactured goods, and the rules for exporting or importing alcohol, tobacco and certain oils. To help with this process, the government has produced a step-by-step checklist for importers and exporters, which can be found on the gov.uk website. If you move goods into Northern Ireland or via it into the EU, then you should also sign up for the government's free trader support service. This free-to-use service is available to businesses of any size moving goods into Northern Ireland, providing guidance, training, a digital declaration support services and support from customs experts. So what are the implications on VAT? Well, VAT at complex is the best of times, but the Brexit transition latest guidance makes the process of accounting for VAT on imports and exports to and from the EU even more difficult. Goods that move into the UK from the EU after the 1st of January 2021 will be considered imports, meaning import VAT and customs duties will be payable and customs declarations will need to be made. Import VAT will no longer be payable when goods enter the UK from the 1st of January, and businesses will instead account for VAT on goods imported using a postponed accounting system. This means that import VAT will be accounted for and paid via the usual VAT return, which will lead to an improved cash flow position for a lot of businesses. This applies to all goods imported by VAT registered importers to the UK, including those from the EU. In most cases, import VAT should be recoverable by businesses, but duty costs are irrecoverable. So, accounting for import VAT on your VAT tax return. Businesses will have to account for import VAT via their VAT return under the postponed accounting system if the goods they import are for use in their business. The business must include its EORI number, starting with GB on its customs declaration, and their VAT registration number if it's needed. A business can then account for import VAT on its VAT return when they submit the declaration that releases those goods into free circulation from one of the special customs procedures. These being customs warehousing, inward processing, temporary admission, end use, outward processing, duty suspension. A business can only account for import VAT on their VAT return once they release excise goods for use in the UK, also known as released for home consumption. If the business imports goods that are not controlled into Great Britain from the EU, between the 1st of January and the 30th of June 2021, they must also account for import VAT on their VAT return, even if they delay the customs declaration or use a simplified customs declaration to make a declaration in their records. New rules for duty deferment will apply in Great Britain from the 1st of January 2021. These will allow businesses that import goods regularly to apply for a duty deferment account to delay paying most customs charges, including customs duty, excise duty, and import VAT. Through this account, a business can make a single payment each month via a direct debit instead of paying for each individual consignment separately. The scheme is open to importers or customs agents and freight handlers that work for importers and have an approved deferment guarantee or waiver in place. Regardless of the method of accounting for VAT on imported goods, checks to ensure that the data on the customs declaration is accurate will continue to be highly important for VAT purposes on all imports. This will be the primary means to ensure that the correct import VAT is accounted for and paid. Imported goods in a consignment not exceeding a value of £135, including specific excise goods and gifts, will not be subject to import VAT at the border. Low value consignment relief will be withdrawn and VAT will be charged on goods as if they were supplied in the UK and accounted to HMRC on the UK VAT return. However, businesses selling goods to the UK with a value not exceeding £135 will be required to charge and collect any VAT due at the time of sale. For UK VAT-registered businesses importing goods in a consignment not exceeding £135 in value that has not been charged VAT at the time of purchase, they can account for this VAT on their VAT return under the usual reverse charge method. Businesses must determine the country where a supply takes place for VAT purposes so they know where the VAT due is payable. So let's have a look at the other VAT considerations. At the moment, the place of supply rules are applied almost identically across the EU member states, and it is expected that the UK will retain similar rights after the transition period ends to prevent disruption. However, a consequence of this is that businesses may continue to create VAT liabilities in other EU member states. This might mean that businesses in the UK will require multiple EU VAT registrations within each member state that they trade within. Now, further clarity on this is expected in future government guidance and may be affected by the outcome of the ongoing trade deal negotiations. Reclaiming VAT in the EU. Currently, UK firms incurring VAT in EU countries can claim VAT back subject to national rules via HMRC's dedicated refund portal. That arrangement will remain in place until the 31st of March 2021, after which time there is currently no provision in place to claim for VAT incurred in 2020 under the terms of the withdrawal agreement. Post-Brexit, there should be minimal impact on the supply of services. Business-to-business services are generally treated as though they are supplied where the customer belongs, and that customer must account for the local VAT. So this will mean that for UK service suppliers, they will continue to not charge UK VAT. For business-to-consumer supplies, UK VAT generally applies, and this is likely to remain unchanged. When receiving services, it is expected that UK businesses will still have to apply a reverse charge to the receipt of services from non-UK suppliers. This would ensure that there is no competitive advantage from sourcing services via non-UK suppliers. So let's move on to how this affects recruitment and retaining talent. The end of the transition period also signifies the end of the free movement agreement between the EU and the UK. So this may mean that the steps need to be taken to retain existing talent or recruit new talent where an employee is an EU citizen. Employers should check whether existing employees from EU member states need to apply to the EU settlement scheme. A person is eligible for settled status if they started living in the UK by the 31st of December 2020 and have lived in the UK for a continuous 5-year period. 5 years continuous residence means that for 5 years in a row, they've been in the UK, the Channel Islands, or the Isle of Man for at least 6 months in any 12-month period. If they do not have 5 years continuous residence when they apply, they usually get pre-settled status. To get this, they must have started living in the UK by the 31st of December 2020 and can stay in the UK for a further 5 years. They can then apply to change this to settled status once they have 5 years continuous residence. Some EU citizens may be able to stay in the UK without applying, for example, Irish citizens or those with indefinite leave to remain. The deadline for applying for settled status is the 30th of June 2021, and so it's important that this process is completed before then. Businesses wishing to retain talented EU citizens may wish to help employees prepare the necessary applications. After the transition period, you can still recruit EU citizens, but you will need to apply for permission and the correct visas. In order to recruit workers from outside of the UK in the skilled worker category, you will need to demonstrate that they speak English at the required level, they have a job offer from a Home Office licensed sponsor, the job offer is at the required skill level of RQF3 or above, equivalent to an A level, and they'll be paid at least £25,600 or the going rate for the job offer, whichever is higher. If the job pays less than that £25,600, but no less than £20,480, the applicant may still be able to apply for permission by trading points on specific characteristics against their salary. So, for example, if the worker has a qualification in a relevant job or has a job offer in the shortage occupation, they are also different salary rules for workers in health or education jobs and new entrants who are starting their careers. The new system will not apply to EEA or Swiss citizens already employed in the UK, as they can use the EU settlement scheme. To become a Home Office licensed sponsor, you must apply online and do the following. Firstly, check that your business is eligible. Choose the type of license you wish to apply for, which will depend on what type of work you want to sponsor. Decide who will manage the sponsorship within the business and, of course, pay a fee. You will also be given a license rating and be able to issue certificates of sponsorship if you have jobs that are suitable for sponsorship. This will remain valid for 4 years as long as you check that your foreign workers have the necessary skills, qualifications, or professional accreditations to do their job, and keep copies of documents showing this. Only assign certificates of sponsorship to workers when the job is suitable for sponsorship, and tell UK Visa and Immigration, UKVI, if your sponsored workers are not complying with the conditions of their visa. The rules are not straightforward, and I would highly recommend that you seek professional advice in this respect. So let's look at the impact on overseas business travel. Well, from the 1st of January 2021, there will be new rules to travel to the EU, Switzerland, Norway, Iceland, or Liechtenstein. Should you or any representatives of your business need to travel to the EU in future, you might need to consider the following. Firstly, check your passport, get travel insurance that covers your healthcare, check that you have the right driving documents, Tell HMRC you'll be working in the EU. Check whether you'll need to pay social security contributions in the country you're working in. Check whether you need indemnity insurance for your employees, and check that you've got the right documentation to take goods to the EU. It's important that you conduct a review of your entire organisation to assess the impact on employee travel post-Brexit and how it may impact your ability to operate and grow your business. Now, it's easy to get lost in the doom and gloom that's being reported around Brexit at the moment, but the new freedoms gained from the UK's departure from the EU could also open up new opportunities and markets. Already, the UK has signed a comprehensive free trade deal with Japan and is in discussions to create a large agreement with Canada, Australia, and New Zealand, the so-called CANS UK deal. Discussions are also ongoing with the USA regarding a trade deal. However, the recent election of Joe Biden has raised new questions about the speed at which negotiations can be completed. More generally, the departure from the EU should allow the UK to establish new trade deals with a wide range of markets. However, with the EU remaining the country's largest trade partner, achieving a deal with this bloc remains a key goal. So, as a final checklist, as the UK is yet to secure a deal, businesses must consider the following: implications for VAT, the introduction of tariffs, the new requirements for importing and exporting goods, new border controls, the needs of EU citizens in their workforce, the impact on supply chains, and scenario planning. So take the time to review each of these points and consider the direct and indirect impacts on your business so that you can put plans in place to mitigate any issues. UK businesses certainly face an uncertain period, full of variables that could affect their income and ability to trade. We're already supporting a number of businesses with their preparations for Brexit and are standing by to support you should you have any queries or need any form of support. If you'd like to know more about the impact Brexit may have on your business and how we can help, why not arrange a consultation with our team to find out how we can assist you? Our contact details follow.